Hi guys, today we are going to discuss about stock depth, which is a framework for stock analysis. So this is the content which we'll be going through today. So we'll be starting with with the introduction to stock depth, and then we'll go through what is DEP, the fundamental part of this framework, and then we'll go through TH, which is the technical part of this framework, and then we'll consider one real life application. We'll pick one stock and see how we can apply this framework to the stock. Okay. Okay, so we'll begin with introduction. So, what is stock depth? Basically, it is a framework which includes both technical as well as fundamental analysis. So, let us go through all the components of it one by one. So, we'll start with the D of depth, which is debt. Debt, which we say in Hindi, is karja. So, to run a company, to meet its regular day to day tasks, it needs money, just like we need money for to run our household. So to run the company, it needs to pay salaries to the people, it needs to buy raw material, it needs to process, it used to have machines, infrastructure. So all that they need money. And so one major source of that money is debt. So debt is basically a borrowing which company undertakes, and it needs to pay the interest for that in the future. So the debt, the lower, obviously it is better. See, debt is something. See, company has to pay the interest, so it reduces their profits. So ultimately, if you are a shareholder, then if the company is making less profits, then you will also be earning less, because the ultimately the stock price corresponds to the earnings made by the company. So we need to keep a tab on the debt of the company. Of course, debt is necessary, but up to a point it is good. Up to a point it is okay, but beyond a point it really becomes a burden, and company cannot generate profits, which is the ultimate goal. Okay, so we'll discuss about this in detail in the coming slides. So next we move on to E is basically earnings here. Earnings is basically the profit generated by a company. So higher the growth rate is basically expressed in terms of percentage, like how much I have grown in last 5 years, 3 years. So we'll also discuss more in details in the coming slide. But it is the biggest trigger for stock price increase. See, stock price might vary due to multiple reasons, like any corporate action, any say promoters are buying the stock themselves and all. But the biggest trigger for stock price increase is earnings. So, if I were to say which is the most important fundamental factor you should consider, then it should be earnings. Okay. Then next we move on to the profit quality. See, this is more in terms of what is the kind of quality of profits the company is generating. Are these profits sustainable? See, one way to show the profits in the book is to get some debt and show it as a profits. So when we gauge the profit quality, then we are able to see, is the company able to generate cash flows. See, showing profit in the books is one thing, but correspondingly showing cash flow is very important. Is it paying dividend to you? Say if the stock is underperforming for 1 or 2 years and you are keeping it, at least dividend is one source of income which you get from that stock. Okay, then we'll also look at the margins, what is the operating and the net margins. So basically, if the company does not have any moat, then it might have very low margins. Say if the prices of raw material increase, then company cannot pass it to the customers. If it is it is not a moat, it is kind of running on a very, say, in a business which has many competitors and all. So we'll check for that. So this covers our fundamental part: the D for debt, E for earnings, and P for profit quality. So next we move on to our technical part. So here we'll see T is for technicals. Here we will see the trend based on the price charts. So in the price charts, we'll look at both monthly as well as weekly chart. Is the company making new highs or new lows? is it the right time to buy or sell, we'll try to gauge here. Okay. And then in the next part we will see, we'll try to see the historical returns of a company, which is the H part. H is we try to see what is the stock performance over a period of time. So here we'll see both long term as well as short term. So this is basically a gauge of price momentum. See, momentum is a very big thing as far as prices are concerned. A stock might be in consolidation for years, or it might continue to grow. It might continue to have momentum for years. So if we are in align, if we make our investments in align with that momentum, then we can get good returns in lesser period of time. Okay. And we also see is the what is the stock price return as compared to the index. Okay. Index here basically will consider Nifty, which is a collection of top 50 companies trading on the market. Okay. Okay, we'll move on to our next slide. We'll look at each of the factor one by one. Okay. So let's go through the fundamentals, the D, E, and P part. Okay. So as we already discussed, D is for debt, which is either a trigger of growth or it could be a cause of wiping of profits. So hereby, what are the measuring parameters which we consider? It is basically the debt to equity ratio. Debt to equity here means debt is something the liabilities which company has, and equity is something the shareholder equity. So the lesser is this ratio, the better it is. The lesser ratio means that company has less debt and more equity, so they can maintain a balance. So we'll consider these are kind of standard parameters. So if it is less than zero point 0.5, then it is very good, and if it is greater than 2, then the company might be a company is very risky. It might run bankrupt. See, it does not guarantee that greater than 2 is a bankrupt, but there is risk involved. We will say greater than 2 is a risky investment. Then to gauge, is the earnings enough from the company to cover for its is the com- is the earnings enough from the company to cover for its debt? So we'll look at the interest coverage ratio. So it is calculated by your earnings before interest, taxes, EBITDA, and the interest expense which company has paid for that particular year. So higher the better, because company is more capable to cover the interest expenses out of its earnings. See, if I am earning 5 rupees and out of that I am giving 4 rupees as interest, then there is no point. Then the company is at the end of the day left with only 1 rupee, and then it has to meet its obligations. Then it has to pay shareholders. So we need to check this part, that company should be able to cover the interest expenses out of its earnings. Okay. Then next we'll consider the current ratio. This basically is the company able to pay short-term obligations. Short-term means if within the next 1 year, company will need to invest on its assets along with its liabilities. So we try to compare here the assets, current assets and liabilities ratio. If it is greater than 1.5, it's very good. If it is less than 1, there is some doubt over the company's ongoing earnings and all. Okay. Then one exception here is this debt to equity ratio. Does this whole thing does not apply to banks or finance sector? See, their main earning factor is by lending only. So for to them, debt to equity parameters do not apply. To all other sector, IT, manufacturing, these are very much applicable. Okay. Then we'll look at E part, which is the earnings. See, earnings is the main reason which the company is doing business. At the end of the day, the entire undertaking, procuring raw materials, having manpower, selling the material to the market, all this is the reason is earnings or profits. So here we will try to have a both long term as well as short term perspective of the company's growth. So here what we look at is like the last 5 years sales growth rate. So 5 years operating profit growth rate and 5 years net profit growth rate. See, obviously higher the better, and yeah. So our aim is that the company should be able to generate double-digit growth rate. Double-digit means at least 10% growth rate in 5 years, 3 years, as well as TTM here is trailing 12 months, or we say last 4 quarters. So we'll see if the company is able to have a good growth rate in the long term as well as in the short term. Also, one factor we'll also consider is the consistency. See, there are many companies whereby 1 year they are generating 100 crore profits, next year they are generating 2 crore profit, then again 300. So these kind of inconsistent companies, we have to be very careful while investing, that if we are investing in them, we should be investing in the right cycle. We should not be investing in the wrong cycle of things. Otherwise, there's a high probability that in alignment with their earnings falling 60-70%, our stock value will also fall 60 to 70%. So we should be aware of this. Okay. So basically, the more the stability of earnings, the better it will be. So next we'll look at our the P part of the fundamentals. P is for profit quality. So hereby we try to answer, are these earnings really sustainable? Okay. So we'll start from right to left. So here first we look at the operating profit margin. So how is this operating profit margin calculated? This is basically how much is the operating profit company is able to generate out of revenue. Obviously higher the better, the more the margins company is able to generate, the better it is. See, our aim for a good stock is around more than 15%, and between 8 to 15% it's kind of average, and less than 7% it's kind of poor. Okay. So here we calculate, say company has a revenue of 100 rupees, then we try to see how much is the operating profit company is able to generate, whether it's 20 rupees, 10 rupees, 5 rupees. Okay. Next, we consider the net profit margin. So this is the in the profit and loss statement. This is also kind of net profit is the bottom statement. Which say at the end of the day, when the company, how much is the net profit company has earned after cutting down all the expenses and after considering all the expenses and the revenues. Obviously, higher the better, and our aim for a good company is at least greater than 10%, and less than 5% will say a company is not doing very well. Okay. Then next factor we see is the return on invested capital. So this is basically the net income or the net profit which company has generated divided by total invested capital in the company. So hereby we are able to gauge, is the company able to generate the profits out of the invested capital, and obviously higher the better, and aim for a good company will be, say, greater than 12%, and less than 7% will say is not a good ratio to have. Okay. Then next we'll consider is dividend payout ratio. Is company giving any dividends? See, dividends is a kind of free income you are able to get when you keep the stock for a long term. The more the dividend company is giving, the better it is. So we'll consider that also. Then we also have the cash flow. So the cash flow is the real cash which company is able to generate out of its activities. So here we'll consider both the cash flows, the operating cash flows and their free cash flow. See, one important thing about cash flow is they are difficult to manipulate or fake. And see, the cash is the primary for running the business. So ideally cash should be your around 100% of the net profit, and if it is between 70, 80 to 100%, it's okay, but less than 70% means there's some disturbances with the company's accounts. Okay. Then free cash flow is the net cash flow which company has after it has, say, from the operating cash flow, it has invested in any machineries, or there are any depreciations. So after that, what we have left over is free cash flow. Okay. So hereby we complete all the fundamental part. First we consider debt, D, then we consider E, earnings, and next we'll consider P, the profit quality. So with this DEP analysis of a company, we are able to gauge whether the company is fundamentally good or bad, and we can categorize it accordingly. When we see an example later, then we'll be more clear how we can categorize that company. Okay. Okay. So next we move on to the stock fund technicals. So yeah. So technicals is basically based on the price charts. So hereby, as we discussed, we'll consider both monthly as well as weekly charts. Okay. So on monthly chart trend, we'll try to see if the stock is making a new high, it is making new lows, or is just consolidating. So we'll be able to gauge the current trend of the stock price. Then we can also consider the EFI. EFI here is Elder Force Index. Let me just move around the window. Yeah, EFI here is the Elder Force Index. It is a gauge for, are the stock volumes favorable? Is the Are there any buyers for the company to invest in it or not? Also, we'll consider the moving averages. So we'll consider here the long-term moving averages, which is like kind of standard procedure followed across the market. 50-day moving average and 200-day moving average. So we'll see the prices above or below. So that is also a gauge of our trend. And correspondingly, we'll also have the weekly chart. Here we'll again see what is the trend in the on the weekly basis. Is it making new highs, new lows, or is it consolidating? And is it the time to buy, wait, or sell? And then we'd also consider the Elder Force Index, which we had considered like for monthly chart. We'll also consider for weekly chart, and also we'll look at the MACD, which is the trend following momentum indicator. So this is basically kind of confirmation for analysis. See, at the end of the day, indicators are basically they can be used for confirmation whether what we are gauging out of our price action is in trend or not. Okay. So next we'll also consider is the historical returns. H here is for historical returns. So what we are measuring here is the returns, price returns for the company in the last 6 month, 1 year, and 5 year. So for 5 year, we'll consider is a CAGR, which is cumulative growth rate. Okay. So we'll check the two things here. Is the return positive? Has the company generated income for its shareholders in the last 5 years, 1 year, or 6 months? And is it beating the Nifty index returns? And is it also beating the fixed income returns? See, if the bank FD is giving me 6%, then my return out of stock should at least exceed. That is the entire point of investing in stocks, right? Because stocks are volatile. At the end of the day, they are a volatile income. So if I'm getting return say 3 or 4% from stocks, but that defeats the entire idea of investing in stocks, right? So we'll consider that way as well. But anyways, we also need to compare it with the Nifty index, because Nifty might be returning say 20% 1 year and 2% next year. So we cannot in the year where Nifty has returned 2%, we cannot expect my stock price to return 50%. So it is very highly unlikely. So that is where we need to factor in that as well. Okay. Okay, so I think enough of theory. So now let's jump to some real-time application for whatever we have learned in terms of both fundamental analysis, which is DEP part, debt, earnings, profit quality, and then TH part, technicals and historical returns, and try to see if we can apply this to some uh, real livestock and all. Okay, so let's jump over to. Okay. So here I'm taking one pharmaceutical stock, which is Ajanta Pharma. So this is the interface for the Trading View app. Okay. Here, so Ajanta Pharma is basically a health technology and pharmaceutical company. Okay. So we'll start from left and move on to right. I'll try to explain as much as possible each and every factor which we are considering here. Okay. So corresponding to the fundamentals DEPTH which we discussed just now, I have created some scripts in the Trading View app. Okay, and this gives me the picture of the stock, any stock in the world, within a couple of minutes. What is the fitting criteria for that in DEP, and then T is something which is very subjective. We'll see it in the stock charts, and H is something which we get like what is the return in 5 years. Okay, so we'll go one by one. So first we look at the market cap of the company, whether it's a large cap, small cap, mid cap. So it just gives a basic idea. See, investing in a small cap or micro cap is a little bit risky. I would not say you should not invest in them. In fact, they are the real what to say money generators. So I think we must invest in them, but we must be cautious about the mix of our portfolio should be mix of large, mid, and small cap. Okay, so talking about Ajanta Pharma, it has market cap of 18,000 plus crore and revenue of 3,700 crore. So the price to sale here is 5. So basically market is valuing this company at 5 times its current revenue, which is on a higher, which is very quite high. Ideally the invest from a value investor's point of view, they invest in like to invest in companies which are PS is equal to 2 or less. So for Ajanta Pharma it is 5 and its PE is 32, which is again not a which is not on the lower side, it's quite high side. 30, you are paying the price for 32 times its current earning. Okay, but there's very subjective things because market might be expecting these stocks to generate good revenue growth and all, good earnings growth. So not much into this. I think it's just good to know this company is not undervalued; it's quite overvalued. Okay. Now we come to the real part, which is the D, E, and P. Here we try to gauge whatever we have learned, all the parameters which we discussed. So we try to put that down objectively into 32 parameters so that there are no subjective emotions, feelings, and all. So these objective parameters out of this 32, company is meeting 23 of them. So its score is 72%, which is a good category. Company is able to meet 72%. So now we'll go one by one. So for debt D, we considered 5 factors, and company is able to meet all the 5 factors. See, we are putting here the last 5 years data. So company has never struggled with the debt. So D part of company is good. Next, we consider the E part. E is the earning part. So here we are seeing the 5 year and the 3 year sales is around 13%, and operating profit, which is also known as EBITDA, is around 5%. So one thing we can conclude here is company is able to generate sales of 13%, but operating profit of only 5% growth rate. So the company's operating margins are coming down, right? And again, its EPS is also 5%. So company is able to generate good sales, but it is not able to maintain its operating margin or earnings margin. And the EPS growth rate, our aim is around at least 10% company should be able to generate. It is only 5%. This is for from the 5 years perspective. Okay. Next, we consider from the 3 years perspective. 3 years again, company is able to generate. Last 3 years, company is able to generate 13% sales, but again, that operating profit and earnings are not matching with that. Not matching in a sense they are quite a difference. So again, company, it's a clear indicator. Company's margins are coming down. Okay, so it's not a very kind of, it only scores 5 out of 12. That too mainly because of its sales part, but its operating and earnings are on the lower side. Okay. Next, we look at the consistency. So for the consistency, we see the consistency of the net income. So see, from in 2019 financial year, company was able to generate 387 crores of profit, and which was minus 17% from the previous year. Then it was able to increase its profits, but in 2023, in the current year, company has lost 17% of earnings. So this company is average kind of consistent. It's not a very stable income generator, but it's kind of average. So its average score is 3 out of 5 here. But it's able to generate good profits. In the last year, its margins are good. So it is margins are at 21%, and 15% is the net margin, which is very good. Our criteria is, say, it should have at least 15% operating and 8 to 9% net profit margin, but it is able to generate 15%. See, one thing to note here is when we said margins are reducing, then in the previous years, company must have the margins greater than this. So, although the margins are currently good as well, 15% is a good number, but they might have in the range of 17-18% in the historical years. Okay, but as of now, in the current year, if we take it standalone, then their profit quality is good. Its return on invested capital, which is a third factor, that is also good. It is giving 11.5% dividend out of its income. So we took a look at the dividend history, then it is giving dividends quite consistently. Okay. Then we'll look at the cash flows. So corresponding to the 587 crore, company is able to generate good cash flows, which is 789 crores, and good free cash flow as well. So overall, this company has good profit quality. So if we sum up all the fundamentals, then company is kind of good. It has good debt coverage. It has average consistency, but good profit quality, and earnings are although on the lower side, but it's kind of uh, worth an investment. I'll not say invest a large chunk of your portfolio, but you can invest worth. Okay. Then we look at the technicals. So for technicals, let's first consider the say H part. We'll cover the T part and when we see the price charts. So H part in the last 5 years, company has generated 17% profit, corresponding to Nifty's 11%. So company is certainly performing well as compared to Nifty, and this 17% is a cumulative growth rate. This is not the overall 17% in the last 5 years, but per year average growth rate has been 17%. And in last 1 year, again company has been outperforming Nifty and last 6 months. So we can say company is in good momentum as well. Okay. So now if we look at now we have covered our fundamentals and the H part, now our T part is pending. So let us look at this monthly chart. Let me just zoom it. Okay. So if we consider this monthly chart, we'll see the company was making new lows since July 21. Company was making new lows till May 22. July 21. This is a monthly chart. It was making new lows, but from May 22 onwards, now company has started forming new highs. Okay, especially we get the breakout in the April. Let me just pull over this window. Yeah, in the April month, it gave a good breakout. Okay. So the thing here is, I think market is expecting the company's earnings to improve in the coming quarters. So even though we saw last year profit has dwindled to say 15%, 16%, it had fallen, but still market is expecting it to do bigger things, and so price has started increasing. So when we see the prices increased this month alone by 13%. Okay, and now we move on to the weekly charts so that we can see more the T part. So here there are two lines, the purple line and the red line. These are the 50-day and 200-day moving averages we talked about. Okay, so as we see, the price as of now is above the 50-day moving average as well as the 200-day moving average. So we can certainly see that the company is in good trend. So company had good fundamentals. Company has good historical return or you say momentum, and company is doing good uh, technical flow of the stock is also good. So I think this company is worth investing as of now. Okay, but we need to see what are the right levels to invest. See, the green dots here represent the resistances, and the orange dots here represent the supports. So ideal time to invest in a stock is when it is just breaking out of its resistance. I know it might be counterintuitive to what we think, like we should always buy on low and sell on high. But I think it is very difficult to predict what is the ideal low and ideal high. So what we do is let the company stock price form a some base, and from there on, when it tries to break out of a resistance, that is the ideal point. Beyond that, company will give us a good return. Okay, so basically you buy high and you sell higher, so that gives you a good performing out portfolio. Okay, and so let's consider for this Ajanta Pharma. So from the weekly point of view, if we see 1328 was the last resistance which it broke. Okay, and going ahead, if we see in the monthly chart, 1569 is the next resistance it might face. Okay, so ideally we should buy when it crosses the 1328, but now that time is gone after 3 to 4 weeks. So next we will consider this stock when it breaks the resistance of 1569. Okay, and this is from we'll say somebody who's buying based more of a say based on momentum, who is a momentum player. If you are a fundamental investor, then you might look for say fundamental or say value investor who wants to try to buy on the lower side. Then you can look at the monthly charts and see where it is trying to form a consolidation. Like in the monthly chart, if we see this, it went till 1060 and all. So if you're not able to like buy at that time, like this 1100 range, this was a good range to buy this company. If you're more of a momentum investor, then you can buy it once the stock crosses the resistance again, which is above 1569, or wait for a pullback till 1328. So these are the two. I'll suggest you can go ahead with this stuff. Okay. Okay. So I think you had a basic idea about like what we covered today, like what is depth, the debt, the earnings, the profit quality, the technicals, the historical returns, and then from there on we try to apply that fundamental as well as technical to this stock. And it might not be very obvious in the first go, but I'll be posting more videos of more stocks analysis, so that you get better understanding of what we are trying to achieve here. Okay, so I hope that was of some help to anybody who is watching this video. And thanks for watching. We'll come back with more videos soon. Thank you.